In the world of early stage venture capital, you aren't just betting on markets or products, you're betting on people. But what happens when the person behind the business shows a red flag and you choose to look the other way? Today's guest is Kevin Brockland, the founder of Indelible Ventures. Kevin has spent his career assessing potential, but he's the first to admit that his biggest mistakes have not come from bad math, but from misjudging human nature. He's been in that dangerous position every investor and founder knows, seeing a flaw, but being so excited by the vision that you convince yourself you can be the one to fix it. It's a mix of ego and optimism that leads to what Kevin calls the errors you should have seen coming. We're going to dive into the psychological trap of the savior complex, the reputational cost of a bad bet, and why in a world obsessed with speed, Kevin now believes you have to move slow to move fast. Kevin, welcome to the pod.
Thank you very much. Glad to be here.
Yeah, great. You've said your biggest failures come from misjudging people sometimes, right? And early in your career, what did you think a winning founder looked like? And how has that profile changed now that you've kind of played through a few of these potential mistakes?
Yeah, I mean, it's a tough question because anytime you're dealing with people, there's not like a single archetype that I can point to and say, as long as it sits within this box, it's perfect. Anything outside of the box is not. So it's tough because we're dealing with a bunch of blurred lines in regards to where things actually land. And by and large, most of people sit somewhere on those lines. And so it's just a matter of like, are they leaning more towards one side of the fence or are they leaning more towards the other side of the fence? And so the nature of it is quite tough. I do remember in my early days, I was fortunate enough in order to meet an entrepreneur named Mark Laurie early on. Most people may not recognize the name, which is a shame because this is a guy that built one of the businesses before I met him. He had built and exited for, I think, a 9-figure sum,
Oh, wow.
a business around trading cards. Collectible trading cards of your sports heroes and all of that. In the early time period, I think if memory serves, it was either late 90s or early 2000s. So it was like early internet days of building basically a marketplace.
Yeah.
And then when I met him, he was building diapers.com.
Okay.
I met him solely from an advisory basis. I wish at that point that I was deploying capital into it because I would have made a killing. Ultimately, he sold that to Amazon for, I don't know, I think it was like 700 million or something like that. There's an interesting backstory on tough negotiation techniques that Bezos used in order to drive the price down because the expected price was higher. But then out of spite, he ended up building jet.com and sold that like a year later to Walmart for like over $1 billion.
Serial successful entrepreneur.
Yeah, so you have this tendency to meet people that just have a very unique perspective and very solid underlying business logic. And I want to emphasize the logic side of it because I've heard him talk about in the few times that I was fortunate enough in order to like be in front of him and have conversations during the role that I was playing at that time. He had very unique perspective on businesses that he was not necessarily directly involved in. We were involved in the bankruptcy proceedings of a company called Circuit City, which was one of the biggest retailers at that time. And we had an interesting conversation around should the next player save themselves, and it was a very interesting way. So there's this inherent aspect of somebody to be able to dissect a business, and we oftentimes hear about first principles thinking, but it's one of those things to where like you don't really know it until you see it. When you like, a lot of people claim to be able to do first principles thinking of boiling things down and all of that. But the same way in athletics that there's a big difference between the pro athlete and your amateur athlete, there is a big difference between like your Olympiad of entrepreneurship relative to most of us mortals.
Time out, guys. Lots of you are watching. Lots of you are learning from the founder fuck-ups that we've all gone through. But please do me one little teeny favor and subscribe so that we can keep growing the channel and get more great founders on. Back to the episode. And I think if in a good comparison, I was actually having a conversation with a friend. We play squash together and we were just talking about footballers. And like, there are so many amateurs that are better than your middle of the range professional footballers on the natural skill. But what they didn't have was that mindset, that ethic, that, you know, way to look at becoming a footballer if you kind of compare it to being an entrepreneur. So what you're saying is this individual, these Olympian grade, they just have that very different focus mindset that gets them from the amateur, the mid-level business leader to your 8-9 figure exiters.
Exactly. I mean, there's also like that competitive nature
Yeah.
that's inside of people. So you're also trying to gauge that competitiveness, that will, and that drive. Because let's be honest, entrepreneurship is very hard. If you want an easy path, go get a salary. But if you want to take on something that has the potential of giving outsized reward, if you're willing to tolerate and survive through the difficulties. And so it's a matter of like who is actually going to end up doing that. So interestingly enough, we find that, and there's data, and I don't have the specific statistics at the top of my head, but there is some research that was out there that was studying college athletes, ex-military, people that have shown the drive and dedication to surpass
Is
a
it the
number of
grit?
complicated endeavors.
Is it the grit? I think there was a grit standard where someone who was just like 1 point above on the grit level would more likely get into the Navy SEALs than someone who's just like 1% lower. It was something that I was saying.
But that's related, but not the same as what I'm talking about. I'm talking about somebody did research on founders
Okay.
and correlated it with there's an outsized representation of former athletes and ex-military that have been successful. They're concentrated in certain fields that are relevant to them.
Yeah.
But there's also the aspect of like, I mean, if you're trying, and I like the sports analogy because if you're trying to become good, you're constantly iterating and revising your approach. If you think about playing football on the pitch, you have to understand fairly complicated dynamics. I mean, the base of the sport is relatively straightforward. Kick a ball, put it into the net, right? But the reality when you're playing against opposition, when you start getting into the technicality of the sport, it becomes fairly complicated. And when you're talking about team sport, even more so. So any athlete that has gone, and it doesn't necessarily have to be a team sport. You could even be talking about like a table tennis athlete or a swimmer or anything really. But that aspect of having to the drive to go through the learning process of failing, trying again, failing, trying again, failing, trying again. Nobody starts off with a first place medal and stays with it for the rest of their life.
Very rare. That's not a unicorn. That's I don't know, a decacorn or
I
something.
mean, to be honest with you, I think when growing up, Michael Phelps probably lost a few swim meets before he became the most dominant athlete in his sport. Michael Jordan had lost. He was a low-ranked draft pick, and then he became the greatest of all time. No matter what any LeBron fan says, it's still Jordan.
When you've been across the table from founders, because obviously you're kind of talking now about figuring out the right kind of profile, it's hard, but you kind of know roughly what you're looking for. But what kind of red flags have you ignored that when you're in front of a founder, they're saying certain things or they have a certain edge? Like, what red flags have you seen that you've then ignored and thought you could fight through them?
Yeah, so I would highlight three ones as far as like overarching categories. The first one I would put in regards to the actual drive and motivation, where there's this cliche saying that chips on shoulders put chips in pockets. But the reality is that, especially in emerging ecosystems, the vast majority of people that go the route of entrepreneurship generally have a safety net. They're coming from the more privileged side of the spectrum. As ecosystems develop, it moves towards the middle, but you don't often see, especially in tech, that it coming from the bottom of the pyramid. More often than not, it's coming from the top. And so one of the red flags is not being able to recognize the dependency on the comfort that they have historically had and that they've normally been treated as default successful because of having come from a privileged background. And so
Mm.
that is common, but it's oftentimes hard to recognize. Now,
Yeah.
I say that, but there's plenty of people that I know that come from privileged backgrounds that still have like this sort of, I need to prove myself and all of that. So it's not like, I'm not going to paint it with a broad stroke, because you have some that have that internal drive, and you have others that,
Mm.
when the going gets tough, they shrink back to comfort, and that's not going to drive success. The other aspect of it is trying to gauge the integrity, because one aspect of it is the drive, the other aspect of it is the integrity. And so some of the red flags that I have come across in the past is relatively what may seem like simple misrepresentations, but I'll be honest with you. Like, if I'm sitting at a table with with a founder, and I ask a question that they don't know, if
Mm.
they make something up just to give me an answer,
Mm.
that's a red flag to me, because if they're willing to do something small, are they willing to do something big?
Yeah.
Is basically the way that I look at it. And I
Mm.
would much prefer somebody say, I don't have that answer, but let me get to it, because that shows the willingness to work and the willingness to find it.
Yeah.
But anything that ends up trying to mislead overtly or invertly, or outright deception or covering up, all of that ends up being big red flags,
Yeah.
and throws into that integrity bucket.
Yeah.
The third category is the interpersonal. And
Hmm.
so I have an instance, and I was telling this story relatively recently to someone, of an investment that we had in Latin America. And the three founders started fracturing between one of them. I mean, honestly, the guy was a complete jerk. I mean, I don't know if I can curse on this, or if I'm going to end
Yeah.
up
It's called
lowering your
founder.
rating. Okay. So yeah, if it's called founder fuck up. So the guy was a complete asshole,
Yeah.
like a complete asshole. And when I came in, I was already at an investment fund that had put a check into them under a
Mm.
different vehicle. And we were getting pressed while I was there from a different vehicle to put in another check.
Mm.
He's the CFO. He's like the ex-I banker. He's not the product. He's not the sales. He's just a guy in the room. And so
Yeah.
I overlooked that red flag, that you had this giant asshole among the three founders with equal share to the people that actually mattered to the success of the business. And it got so heated that at one point they're getting into an argument, and he chucks a telephone across the room into to the wall. And you know those like conference phones, those big like spider ones that
Yeah.
sit in
Yeah.
the
Yeah.
middle? We're in a
Yeah.
conference room, and he grabs in a heated argument and chucks it against the wall. Those things
Jeez.
aren't cheap, but like, it's the matter of like, it became a hindrance to the business.
Of
And so I
course.
think that there's an aspect, there's always this aspect of how long will the honeymoon last?
Mm.
Because when you start off with a business, you're in the honeymoon phase.
Yeah.
But how many marriages end in divorce?
Unfortunately, well, 60%.
Exactly. A large chunk of them. And the reality is that founder splits happen very frequently. And
Yeah.
so trying to get an understanding and trying to be able to identify any of those red flags that signal that the honeymoon won't last very long. And so those are really the three, when coming to people, those are really the three main buckets that I think
Yeah.
the vast majority that I've seen and experienced have fallen into.
I think all three of them make the most sense. And I've actually seen here in Malaysia a couple of groups of founders that have just started to absolutely disintegrate because they were kind of thrown into a bucket from organizations like Antler and these kind of matchmakers.
Yeah, the matchmakers are problematic because you get pressured into like marrying up with a co-founder.
Yeah.
And most of them don't put proper founder agreements in place. They don't create vesting shares so that when that conflict happens, there's no prenuptial agreement. You know what I mean?
Yeah. And obviously, you said to me before the show that something like the error nobody could see coming is easier to cope with than the one you should have seen coming. right? Like these
Yeah.
red flags. What's the kind of psychological toll of that on you? Like, how does that affect your confidence as an investor when like there's a predictable failure that happens?
Yeah, yeah. So I mean, I don't know. You probably know the saying, "You are your own worst enemy." And I find that
Very true. Very true.
I am a very competitive person, especially with myself.
Mm,
So I have a tendency of being my harshest critic, and
mm,
I have a tendency of obsessing over things
mhm.
way longer than I should ever actually do it. But like, that's a process of learning because
Yeah,
the fool me once, fool me twice, blah blah blah. That cliche saying as well. We
yeah.
have to learn from our mistakes. It's okay. Like it's okay if I fuck up.
Mhm.
I get it. I'm going to. Like nobody is going to get 100% of personal assessments
No.
of the psychology of a founder, not knowing what the future circumstances that they're going to have to cope with and trying to make a judgment call of whether or not they're going to have the durability and the veracity to overcome it. I'm going to fuck up. And but the thing on it is if it's because I should have seen something, then I obsess on that. Why didn't I see it? Or if it's something that I feel that in retrospect, because I always do like these postmortems of what went
Yeah.
wrong, especially to be honest with you, even if a company hasn't failed, I'm still looking at them if they're moving slower than I thought. What was
Yeah.
wrong with my thesis? What was wrong with the company? What ended up breaking down in the judgment, all of this so that I can end up improving decision making going forward. And if it's something that is like pandemic happens and everything gets shut down and the business goes bankrupt, it's kind of like, oh, I didn't see that one coming.
There's not much.
I'm not gonna feel so bad about it.
Yeah.
Heaven forbid if a founder ends up like if the primary founder ends up like falling off a cliff,
Mm.
key person risk is a risk. We all want to try and get far enough along, but if it's still early days, key person risk will kill a company. And so
Yeah.
there's a lot of things that can be unforeseeable, but man, when you feel like you should have seen it coming, it like sticks in your gut and your brain and like you keep obsessing over it. And the difficult part is to not let it jeopardize and cause you to say no to something that is still good.
Yeah.
So that's the tricky part because with any early stage company, there's 1,000 reasons to say no,
Yeah.
but there's generally only one or two reasons to say yes.
Yeah. And then you got to try and compartmentalize that, right? Because you go through the postmortem, you're taking it, shall we say, badly, not
Mm,
badly, like you said, you're obsessing over it. But there's other parts, and then you've got to go and raise capital, which is
yeah,
sales and marketing. You've got to go and travel. You've got to spend time with your family. You've got to go and
yeah.
meet your other founders, and then maybe you start to what's the word in? There's like a therapy word where you put something on someone. I don't know. Shit, it doesn't matter. But then you'll go and meet another founder in your portfolio, and there'll be some similarity to the other
Mm,
one. You start to be like, hey, are you like that guy? And you start to overthink.
yeah, yeah,
So
yeah.
I guess the trick is, I think it's very good that you're obsessing over it because it means you're just going to optimize and improve constantly, which
Mm,
is the journey, right? It's how many failures do we make until we, succeed?
yeah.
But that compartmentalize must be tough for you.
It is because like I'm dealing with two sides of the business, the aspect of the fundraising and the aspect of the investing. And
Uh-huh.
on each side, there's multiple parties that I'm engaging with, whether a variety of potential investors, current investors, etc. And then on the on the investment side, companies that I'm considering, companies that I'm invested in. So
Mm.
across the board and on each side, as well as between the two sides, there's a lot of context switching. And
Mm.
so the tricky part is getting better at pattern matching. So one of the things that we have the benefit of out here in Southeast Asia is that we're behind the development curve. So we
Yeah.
have some capability in going to more mature ecosystems and essentially trying to predict the future. But as a famous American author once said, history doesn't repeat itself, but it can certainly rhyme.
Mm.
And so that's the pattern matching of, and I guess what the next lyric to this song is.
Yeah.
Um, and so that's the more tricky part, and that's where the learning of
Reading the tea leaves.
Yeah, yeah. I was gonna go on with the song reference of like the rhythm and tempo, but yeah.
When you've had one of these, I don't know how deep one of these mistakes went where you kind of overlooked something you kind of knew you shouldn't have. But
Mm,
obviously, like a full loss would be kind of the worst financial outcome. Obviously, there's impact on relationships or reputational damage. The investment community, especially here in Southeast Asia, is quite tight knit ecosystem. How long
yeah.
do you think stink of a bad judgment call could stay with an investor?
So I think, to be honest with you, like a bad judgment call is going to happen.
Yeah,
So like out of my portfolio of companies, I'm not going to get them all right. What
no,
I need to be able to justify is that it made sense at the time that I invested in it. Here's what I potentially had missed at that time. And here's how I'm going to improve the next time that I'm going to deploy capital. Because to be honest with you, VC is one of the few range of businesses where you only need to be right 20 to 30% of the time,
and
and the rest of it doesn't matter. So you can fuck up a lot.
yeah.
I mean, they shouldn't seem like it when you're getting into it.
You're not going in with the plan to fuck up.
Yeah, 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 yeah.
I was
Uh,
reading,
so I mean, if anybody comes to me and says that they're gonna start building a bridges on the moon in anticipation of colonization, and they're anticipating that their first one will be this year. I mean, that sounds like it's not going to work out.
it's a bad judgment call.
Yeah, that would be a very bad judgment call.
Okay. So obviously there's expectations. It's not, so long as you're not having everything be a bad judgment,
Yeah.
is winning 20-30% of the time, you're not really getting that stink.
Yeah, I mean, to be honest with you, like there's in the VC space, especially in the early stage, your worst case scenario is that you lose all your money
Yeah.
on an investment, on one bad decision. The upside potential is that you can make infinite multiple of your capital. If you are fortunate enough in order to find the next rocket ship that takes off, and next thing you know, you've 100x, 1000x your initial
Yeah.
investment.
Like if you
Um,
see the next grab or something, you're a happy person.
right, exactly. You probably would have hoped that the Nasdaq listing would have led to an increase in value as opposed to a near complete wipeout of the listing price. But certainly, it's bigger than when it started. And so, like,
Yeah.
those first investors are probably okay. The last investors in were probably not very happy,
Yeah.
except for the SPAC guys. 'Cause they made off like bandits, I'm sure.
But
Mm. But
when
yeah, I mean, there's a big upside. Now, me myself, I'm not like I would love to see some of these massive return outcomes, but I think that the probabilities in Southeast Asia for unicorns or massive sort of outcomes, the probability is significantly lower than you would find in developed markets.
yeah.
So if that's the goal ambition for a founder, they're going to end up having to target Western or developed markets in order to achieve that outcome, just because the TAM is not here. But we can certainly find big outcomes.
Yeah. Kind of you're assessing people, right? And you kind of need to move a bit slow when you're assessing people.
Mm.
But how do you how do you do that practically when if the assessment of people takes too long, you could lose out to like the best founders to faster moving funds?
Yeah, I mean the positive is in Southeast Asia, there's not really fast moving funds.
So you're all very cautious. You're all very slow.
Yeah, there's most of them are pretty slow, and like the vast majority of the investors in Southeast Asia, they know consumer, but they don't know B2B. There's very few investors that actually have inbuilt competencies on the B2B side of the equation. They've historically been centered on the consumer side of things. But it is true that like there is a chance that we could miss the boat. There's a chance that we could, if somebody's doing rolling closes, we could get stuck with a slightly higher valuation. But at the end of the day, I think I'm generally always biased to action. But I have to have the level of comfort
Mm.
in the decision. And I'm not the type to get rushed by FOMO
Right.
because that I just don't. I think, to be honest with you, when a lot of people tell you it's a great idea, it's probably not. When some smart people tell you it's a bad idea, it might actually be good.
That's a good one. I'm not sure how you can turn that into a formula.
I'm not sure the mathematical proof that we could end up doing, but it's one of the reasons why I also don't like decision by consensus, because I think when investment committees require decision by consensus, it is defaulting to the mean, and the mean is not the outlier. We're looking for outliers. We're looking for the ones, if something's a sure thing, the idea, the execution is probably too obvious, and they may have a first mover advantage, but that's something that's going to dissipate, and then it's going to come down on who's the better operator. And so I want to find those operators in the perhaps less consensus or non-consensus spaces that have more chances to produce those asymmetric returns that we're targeting.
Yeah. Wow. And like founders, I think often do exactly what you've done, right? When we go back to those three examples you gave of the red flags that perhaps we missed, I think founders make those same mistakes with either a co-founder, which is one you've literally described, or even early hires. And they kind of, maybe they're thinking I can fix them or I can make this work, or, you know, I can cover them. And based on what you've learned, and, you know, there's definitely been a form of loss of capital from this in some capacity. What would you say to a founder who is about to marry themselves to a partner? They are seeing those red flags.
I mean, I think first and foremost, if you're going to go down that path, it's very important to have a prenup, essentially. The same way of thinking about it as a marriage. You want to put in contract terms what happens if we break up. And you also want to spell out the roles and responsibilities so that there's a clear definition of who's doing what, and that creates a level of accountability around it. Because ultimately what oftentimes ends up happening is you're not carrying your weight, I'm doing too much, or I contribute more value, or maybe both people are doing perfectly fine and then they just don't like each other anymore. You know, the sort of like when you see somebody so often, all of a sudden you can't stand the sight of them and you're no longer less buddies. You just kind of like end up building up resentment, and you need to figure out how to part ways. If you part ways, there needs to be some sort of reallocation of the shares, and it's really difficult to negotiate that process if you don't have terms in the first place. So first and foremost, I know it's a difficult conversation, but put in a prenup. Don't always think that everything needs to be divided 50-50 or evenly amongst founders, because the role and responsibilities and the capabilities of people are not evenly distributed. Somebody is better than the other people. Inevitably, it's just the nature of the beast. So having those sort of understandings, I think that ends up de-risking some components about getting into the co-founder relationship, because you have an exit hatch.
I like that. I never thought about a prenup for co-founders. That sounds like a resource we should build for people to like download. Like, this is a quick prenup.
I mean, there's a bunch of like founder agreement templates that are out in the universe. There's like share vesting. So like if you do a co-founder, when you first start the business, agree, hey, we're going to vest our shares over 4 years so that we're getting allocation based upon the amount of time spent. There's a bunch of times I've seen somebody like start a business. One guy drops out in year one, but still has 40% of the business. Has done nothing to the success of the business, but has that 40%. Man, talk about a lottery ticket. That could be a scam of just going around and collecting shares and be like, sure, I'll be your co-founder. Sure, I'll be your co-founder. You don't want that, because then it's extremely hard to raise, because we call that dead equity when there's a large sum of equity that should be quote unquote founder equity, and it's just sitting there without anybody contributing to the business. That's dead.
Well, Kevin, I really appreciate coming on the show. And if anyone wants to get in touch with you, how should they?
Find me on LinkedIn. I'm super active. Just look for Kevin Brockland. I should be the only Kevin Brockland that pops up. If you're not able, if there are multiple choices, just look for the ginger, because I guarantee that I'd probably be the only one that fits, that check marks both of those boxes.
All right. Appreciate it. Cheers.
Yeah. Thank you.